Have you ever wondered how some traders always seem to be one step ahead, predicting big market moves with precision? Today, we're going to uncover the secrets behind two essential trading ideas: liquidity and market structure. By understanding these concepts, you'll learn where the big moves are likely to happen and how the so-called smart money sets up their trades. In this video, we'll explain how liquidity, areas where many traders place their exit orders, and market structure, the overall flow of price movements, work together to create trading opportunities. Before we dive in, please hit the like button and subscribe to our channel if you're new. We're here to help you build a solid foundation in trading. What is liquidity? Let's begin with the basics. Liquidity is all about how easily you can buy or sell an asset without causing a big price change. Picture a bustling market. When there are lots of buyers and sellers, trades happen quickly and prices stay stable. In trading, liquidity often appears in specific spots on the chart, usually where many traders have set their exit orders, such as stop-loss orders. Think of stop-loss orders as safety nets that protect you if the market moves against you. When lots of traders have their stop-loss orders placed at similar levels, these areas become hotspots of activity. Large, experienced traders can target these zones to trigger a cascade of orders. When these orders get triggered, it clears out weaker positions, allowing the bigger players to move the market in their favor. Now that we have a basic understanding of liquidity and why it matters, let's move on to exploring how you can spot these key liquidity areas on your trading charts. When you look at a trading chart, one effective way to spot liquidity is by finding areas where the price repeatedly touches the same level, what we call equal highs or equal lows. Imagine your chart as a landscape with hills and valleys. When you see several peaks at nearly the same level, that's an equal high. Similarly, multiple valleys around the same price point represent equal lows. These levels are significant because many traders tend to set their stop-loss orders near these repeated points. Retail traders, for example, might expect the price to bounce back when it reaches a familiar low. They place their buy orders near these levels, with stop-loss orders just below them to limit losses if the price drops further. However, savvy institutional traders wait until the market has forced these stop-loss orders out. This action, known as a liquidity sweep, clears the path for a more decisive move in the direction they favor. With a clear idea of how liquidity zones look on a chart, let's now shift our focus to understanding the overall flow of price movement, which we call market structure. Market structure refers to the patterns in how prices move over time. In simple terms, it's the blueprint of price action, the series of highs and lows that tell us if the market is trending upward, downward, or moving sideways. For instance, in an uptrend, you'll notice a series of rising peaks and valleys. Each new high that is higher than the previous one signals that buyers are in control, and the trend is likely to continue. Conversely, if the price makes a lower low after several higher highs, that could be a hint that the trend is weakening or may reverse. Market structure isn't just about drawing lines on a chart. It's about understanding the behavior behind those lines. It helps you decide when it might be a good time to enter or exit a trade based on the underlying strength of the trend. Now that we've broken down market structure, let's see how combining this with liquidity can reveal even stronger trading signals. How liquidity and market structure work together. Liquidity and market structure are like two pieces of a puzzle that, when put together, provide a clearer picture of what the market is doing. When you spot an area of repeated highs or lows, the market structure, you're also seeing where many traders have placed their stop-loss orders, the liquidity. Imagine you're in an uptrend. You see a level where the price has bounced back several times, a clear sign that many traders are watching that area. Here, retail traders often set their stop-loss orders just below this level. A smart trader will wait until these orders are triggered before entering the market. This waiting period is a moment of anticipation, as the clearing of these orders often sets the stage for a strong upward move. Similarly, in a downtrend, the price may repeatedly hit a resistance level where traders have placed their stop orders above. When the market briefly pushes past that level, it can trigger a series of orders that, once cleared, allow the market to drop further. With this combined view in mind, let's move on to discuss some advanced ideas that build on these principles, such as liquidity grabs and order zones. Sometimes, the market makes a brief move against the overall trend to trigger those clustered stop-loss orders, a phenomenon we call a liquidity grab. For example, in an uptrend, the price might dip just a little below a key support level to clear out stop-loss orders before resuming its upward move. This short-lived dip is not a reversal. It's just the market's way of collecting liquidity. Another important concept is that of order zones. These zones are areas on the chart where large traders have placed significant orders. These areas can act like magnets because the market tends to return to fill in any gaps left by earlier moves. By paying attention to these order zones alongside liquidity areas, you can pinpoint better entry and exit points. The key takeaway here is patience. Instead of jumping into a trade at the first sign of movement, wait for the market to clear out weaker positions. This extra step often gives you a clearer signal and a better setup for entering the trade. Now that we've looked at these advanced ideas, let's explore how using multiple time frames can further enhance your trading decisions. A great way to confirm your trading ideas is to check different time frames. Each time frame can tell you a different part of the market story. For instance, a 15-minute chart might show you immediate price moves and pinpoint liquidity zones, while a 4-hour chart reveals the overall trend. When both time frames point in the same direction, you have a stronger signal. Suppose you notice a potential liquidity grab on your 15-minute chart. Before making a trade, check your 4-hour chart to see if the broader trend supports that move. This way, you avoid acting on short-term market noise and align your trade with the bigger picture. With these techniques in your toolbox, let's put theory into practice by looking at some real-world examples. Now, consider a downtrend. On your chart, you see the price hitting a resistance level where many traders have set their stop-loss orders above. If the price pushes above this resistance briefly, it might trigger those orders, clearing the way for a stronger move downward. In this scenario, you'd wait for that liquidity sweep before entering a short position. Your stop will be placed just above the recent high, ensuring that your risk is managed properly. Having seen these practical examples, let's address some common challenges and pitfalls that traders often encounter. Even with a well-structured approach, the market can still be unpredictable. One common mistake is to interpret every small dip or spike as a change in trend. Remember, a brief move against the trend is often just a liquidity grab, not a signal that the market is reversing. Always confirm your analysis by checking higher time frames and looking for other signs before making a move. Overtrading is another pitfall. With many signals coming from the chart, it's tempting to jump into too many trades. Instead, focus on quality over quantity. Stick to your plan and only trade when your analysis gives you a strong, clear signal. Risk management is your safety net. Always set a stop loss and make sure you have an exit plan in place before you enter a trade. This discipline not only protects your capital, but also helps you remain calm when the market moves unexpectedly. Now let's bring everything together into a clear, step-by-step strategy. Here's a concise plan that integrates all the concepts we've covered. 1. Start with the bigger picture. Begin by looking at a higher time frame, like a 4-hour or daily chart, to understand the overall trend and identify major support and resistance levels. 2. Zoom in for the details. Switch to a lower time frame, such as a 15-minute or 30-minute chart, to locate liquidity zones where the price repeatedly touches the same level. 3. Watch for liquidity triggers. Be patient and wait until you see a clear signal, such as a brief move beyond a key level, that indicates the stop-loss orders have been cleared. 4. Confirm with multiple time frames. Check that the signal on your short-term chart aligns with the broader trend on your higher time frame. This step helps filter out false signals. 5. Enter the trade with clear rules. Once the liquidity has been triggered and the market structure supports the move, enter your trade. Set your stop loss just beyond the recent swing low or high to limit your risk. 6. Monitor and adjust. As your trade progresses, keep an eye on both the short-term and long-term charts. If conditions change, be ready to adjust your position or exit the trade. This step-by-step plan transforms your trading from guesswork into a systematic approach based on observable market behavior. With a solid plan in place, let's review some key takeaways to reinforce what we've learned so far. Liquidity. This is where many traders set their exit orders. These areas can signal where large market moves might occur. Market structure. The pattern of highs and lows shows the overall trend and helps you understand if the market is likely to continue moving in one direction. Combined insight. When you see a liquidity zone within a clear market pattern, it often sets up a strong trading opportunity. Multiple time frames. Using both short-term and long-term charts ensures that you're not misled by temporary price movements. Risk management. Always have an exit strategy and stick to your plan to protect your capital. These concepts, when combined, offer a powerful framework that can make your trading decisions more systematic and less based on guesswork. Before we wrap up, let's take a moment to see how you can apply these ideas in your daily trading routine. Now that you've learned the theory, it's time to put it into practice. Integrating these ideas into your daily routine doesn't have to be complicated. Here are a few practical steps to help you get started. Develop a trading journal. Write down your observations on liquidity zones, market structure patterns, and the signals that you notice on different time frames. Over time, this journal will become a valuable resource to refine your strategy. Set up a checklist. Create a simple checklist based on our step-by-step plan. Before entering any trade, run through your checklist to ensure that you have confirmed the signal on multiple time frames and have planned your entry and exit. Practice patience. Wait for clear signals rather than rushing into trades. This discipline is key to successful trading, as it helps you avoid getting caught in market noise. Review and reflect. After each trading session, take a moment to review your trades. Identify what worked and what didn't. This continuous learning process will help you improve over time. By following these steps, you not only apply what you've learned today, but also build habits that will support your growth as a trader. By combining these strategies, you transform trading from an unpredictable guessing game into a process that is methodical and clear. Remember, each trade is an opportunity to learn and improve. With patience and the right strategy, you'll be better positioned to navigate the ups and downs of the market. If you found value in this deep dive into liquidity and market structure, please give this video a thumbs up and subscribe to our channel. Your support not only motivates us, but also helps us continue to bring you clear, actionable insights that can make a real difference in your trading journey. Thank you for joining me on this exploration of how smart traders use liquidity and market structure to their advantage. I hope you feel more confident about spotting those key signals on your charts and applying these ideas to your own trading routine. Happy trading, and I'll see you in the next episode.